Now let's turn to financial ratios. Financial ratios are just ratios related to financial information. So we took some of the value, or some value that we get, and divide it by a reference so that we get the unit value, and it's quite useful in the sense of getting a very proportional sense of the situation. For example, if you say that it equals 1, you know that they are probably the same. When you say that it's only 0.1, you say the ratio is very small, it's only 1/10. What does it mean? Or sometimes you say it's 27 times. That's also a different kind of information. So ratio just give us this sense of the magnitude of the differences. We can use it in many different places, and the value of the ratios are not in a lot of cases different ratios you cannot compare them, right? I mentioned that 27 times, the other is 0.1%. So which one is better for making assessment of the situation? It's hard to say. And one ratio is 27, the other ratio is 24. They cannot be compared either, because they are addressing different issues. So these ratios give us a quick feeling, a quick sense of the situation. But whenever we use these ratios, we need to be very careful. Although those ratios also provide some very fundamental information, and does help us to calibrate our process, or does help us to pinpoint certain issues in the business practice. So we're going to look at some of them, but in general, you can see that we in the textbook, these ratios were grouped into 5 categories. There's one category about debt, right? We don't want to owe too much money. If a company is owing too much money, then it could be quite risky. Liquidity, right? You can imagine that you seem to have a lot of assets, but then most of them cannot be turned into money, and so that reflects how flexible you are. Or asset management, right? You own a lot of assets. Do you really need to own that much asset to generate a business? That was a question, right? So you want to see whether or not they are owning too much asset to generate certain outcome, right? So you put in too much investment for not very big return. So that could be an issue. Or profitability, you put in a lot of money, you generate a lot of return. That's good. If you put in a lot of money but your return is very limited, then you need to figure out a way to either increase the return or reduce the investment. Or something about the potential of your business, right? If you are making certain profit, which is the same as another company, but that company, the stock price of that company is a lot higher than yours, that you can probably guess or figure out that it could be because the perception of the customer, they perceive the potential of the business, either in different industry, or how good the company is. Okay, so that also help you to assess your situation. So let's take a few examples. let's look at debt ratio. Total debt over total asset. So you can imagine that you probably don't want to owe too much money out of your asset, because with debt you need to pay for that. It's not just debt. So if you owe too much money, you're quite risky, because when it reach certain level, you may not be able to pay back the interest and return the debt, and you will be getting into a financial crisis. Usually, for different kind of ratio, they have different range of value that represent reasonable situation. For example, for debt ratio, let's just say between 0.3 to 0.6 of the debt ratio is probably still okay. Again, it depends. And if you are towards the higher end, 0.6, then you are said, it's probably not very healthy. If you are exceeding 0.6, definitely not healthy, right? So these ratio can be measured against the a certain range and see how healthy that situation is. And also, again, here you have times interest over interest expenses. That also show whether or not how likely you will be able to meet your annual interest payment, right? If the ratio is a lot higher, then because your earning is higher and your interest expense is low, so it's more likely that you will be able to pay off your interest payment. Like there's this current ratio, basically, as you can see, it's current asset over current liability, right? We want the liability to be smaller, but we can also, meaning that you have you use asset, you need to respond to the creditor demand. So you need to turn them into you need to repay to the your creditor. But sometimes we will look at the so-called quick ratio, because when we are returning such kind of debt, we don't want to sell off our inventory, because they can still create value. So we also want to see this so-called quick ratio, that is current assets minus inventories divided by current liabilities. And for at least for students from the industrial engineering or from the manufacturing or production areas, inventory turnover ratio is something very, very useful, and it is commonly used. The ratio is equal to sales quantity or sales amount divided by average inventory balance. So it means that for every inventory that every piece of inventory or every unit of inventory that you hold, how many more times of the sales you can create. So we don't want to have like what inventory turnover ratio equal to 1, which means that for every item I sell, I need to always keep one item in the inventory. But if I can sell 100 items and only keep on average one item in the warehouse, my inventory turnover ratio will be 100. So my inventory holding cost will be a lot lower to support the kind of sales that I have, which is a very good situation. Meaning that the supply chain or the inventory policy is very, very effective, so that we don't need to hold a lot of inventory to meet a certain kind of sales or certain kind of demand. So inventory turnover ratio will be the bigger the better, right? The bigger the better. With a unit of average inventory, you can have a lot more number being sold in the market. However, as I said earlier, that these kind of ratio, the value of the ratios differ by industry. Right? If you have, say, airplane manufacturing company, well, your turnover ratio will not be too high. If you have a bakery shop, right? Every day you need to sell out everything. So on average, you only have like 1 day of the inventory, but you do 365 5 days of business. Then your turnover ratio will be a lot higher. So usually you will compare turnover ratio with companies of the same industry or of the like similar kind of industry. But from time to time, you can also compare with industry outside your industry and see how come they can have much higher inventory turnover ratio than yours. Then you can make some breakthrough in terms of inventory management. Okay, but in general, these values do have their own characteristics in different industries. And we can look at something called days sales outstanding, but it's basically, again, you sell a lot of items, and on average each day you sell a certain amount, and you are still a lot of money that you haven't recovered back, a lot of revenue that you haven't recovered back. If you divide it by average sales per day, then you can know on average how many days is required for you to recover or to receive the true sales value. Okay, that is also helpful, so that you know that how much money you still need to have so that you can sustain until you receive the sales money. And also something like total asset turnover. Again, you don't want to hold too much asset to create sales. You want to reduce it. So again, the ratio should be the bigger the better, just like the inventory turnover ratio. You want to make sure that holding fewer inventory, holding less asset, you can create more sales. And profit margin, you can probably understand that already by the words, right? What's the margin, their profit margin on the sales. Of course, it will be the bigger the better. Return on common equity, it is just your common equity and how much return is going to generate. Right? It's also similar to the previous one. And we mentioned about the trend of the industry, or how customers or investors perceive the value or the growth potential of your company. Usually we can use this price earning ratio. Right? Your earning is not that much, but your stock price is very high. The ratio is very big. Right? When it gets to the value which is unreasonable, chances are there could be a bubble coming up. But the market doesn't function rationally all the time, and sometimes such kind of big ratio is reasonable for a short period of time. Then eventually you will come back to its norm. So we still need to be very careful interpreting such a situation. So usually we look at the company and want to see how much profit, how much earning the company will make. Then we decide whether or not we want to, which is the profitability, by the way. Then we want to invest, and we want to use higher price to obtain the partial ownership of the company. So that reflects our perception on the value of the company or on the potential value of the company. So price earning ratio is very popular for people buying, evaluating the chances of buying stocks, right? Different stocks from different company. Whichever has a higher price earning ratio indicates the trend. But when it gets too high, then there should be some adjustment. So if you enter too late, then it becomes a risk, which is just the opposite of what you want. And also market book ratio has similar flavor, right? Market perception, market price per share, and your book value is per share is very, very low. So meaning that they perceive that you have higher potential of returning their investment. Well, I have mentioned earlier that those financial ratios are helpful, but they have their limitation. Because the entire financial situation is dynamic. You don't look at the specific point and look at the value and say that this is the situation. Okay. So that specific point of time, the information obtained from the specific point of time may mislead the interpreter. And also, it's hard to say that this ratio, this value, is good or bad. Meaning that when it's big, it's generally good. But what does it mean by good? For example, PE ratio, I mentioned that, when the PE ratio is bigger, meaning that the trend of the industry is right. But when the PE ratio is too big, whether or not it's a true trend or it is a hype, we don't know. So it's hard to tell whether or not it's good or bad just based on the value. Although we say that in general it should be, in some cases, in some ratios, we say that the higher the better. In some ratios we say that the lower the better. And we also mentioned that they all should have a range indicating certain stable or more stable situation. But it doesn't apply to. It doesn't apply generally to all of the cases. A lot of time there are special cases. Sometimes it's case by case. So we still need to examine the detail rather than just relying on the ratio directly. And again, year-end assessment of the financial status of a company, if we only use some ratios, it is still quite risky because it is just a point, right? A very superficial point, that is year-end or annual point, and those points reflect the situation at that time, but it doesn't reflect all the process occurred during the course of the year. And there could be a lot of situation, and this point is the best situation it has. Maybe after 1 month it will go down quickly, or it can be just the opposite. It looks very bad right now, but this is the worst sign of the year and it's on the way to come up. So it still requires more detailed examination of more data, at least from the financial statement, and you can dig in further from more detailed information, more detailed items, and maybe explore them and see what exactly happened, so that you can get the more truthful information about the financial status of a company.